All right, big CPI report coming up. We're going to talk about that in a minute. But first, I just want to get your take on those two sound bites. Your boss, Jamie Dimon, saying one thing, saying that he sees a possibility of stagflation. Brian Moynihan, the head of Bank of America, saying that their economists don't see it. How do you see it?
I mean, look, if you look out into 2025, there's still a lot of risk there. The services side of inflation is still running high, but then there's the whole debate on also what will happen with respect to tariffs. And if you have an increase in tariffs, and just some of the work that we have done looking this in research, so you look at a 10% universal tariff, we think that could bring inflation up 1.5%. 60% tariff on China, right. 1% increase in inflation. So you look ahead between services, between some of the tariff risks that's associated with the elections, you could still have some upside surprises as we look out into making a 2025 forecast on what will happen. But I think more immediately, what we're going to see is that some of these upside surprises are ebbing, and we're still sort of on track. And I think the time is right for a 50 basis point cut.
Okay, so you're jumping ahead to 50 basis points. I was going to ask you about that anyway, but I just want to go back to what you were just saying. Yeah. It sounds like you're saying the idea of stagflation is really dependent on the outcome of the election. I mean, because only one candidate wants to see tariffs.
Well, but the tariffs are not going away. But you're also going to see, I think, under either probably some higher fiscal spending. But also, we do see that growth is slowing down here. So the stagflation story, part of it's inflation, part of it is the growth outlook. And we're not seeing that in Europe and in Asia that growth is picking up that much. So it had really been anchored on the U.S. growth story, which is slowing down. So we've still got a global expansion that's going, but it's uneven.
All right, we're going to get back to your idea. So you want to see a 50 basis point cut. So we've heard different people coming on with different ideas about a 50 basis point cut. Some people think that would spook the market. Other people think it's needed because the Fed's actually behind the curve.
Well, look, it's a dual mandate. And right now you do see some moderation of the labor market. And I do think that the combination of some of the upside risk on inflation over the near term coming down and the labor market conditions softening, which is at odds with the rest of the world, really put in place 50 basis point being the right thing to do. Now, when we look at the rest of the world, we think the gradualism is going to continue there. But for the Fed, I think the focus is on the dual mandate, and they're looking at the labor side of it. I think there's still a debate. Wouldn't necessarily say that this is something that's unanimous, but we're looking at 50 basis points.
All right, so the Fed has a dual mandate. You have dual responsibilities, too. You look at the economy. You also look at the markets. I know you're saying that this cut is going to be good for cyclicals. We're going to show a chart of cyclicals. Staples, actually, Staples is defensive, but healthcare, utilities, since Jackson Hole, they've moved higher than the market. The market's down about 1.33%. Staples and utilities up over 2%. Does the 50 basis point cut, does that continue that run to the upside? Does the 25 basis point cut, is that already priced in? I mean, give us a sense of what this all means for the markets. Even though you think 50 basis points is right for the economy, what does it mean for the markets?
Look, I think that 25 basis points is definitely priced in. I think 50 basis points may not be fully priced in at this point in time. But I still think that some of your defensives are going to do better here. I mean, healthcare, utilities. We do think that also that on oil, it's undervalued right now. We think 80 is still the target that we have as well, given that some of the risks that we see ahead and where stocks are at right now. So the defensives, I think the last 6 months have outperformed, and I think that you could still see more of that. A lot of the carry trade unwind, I think most of that is over, but still you had quite a lot of positioning in some of the Mag 7 credits.
Wait, why do defenses outperform with a 50 basis point cut? Doesn't that set up cyclicals? That seems confusing or a little bit contrary to conventional thinking.
No, well, I think that you still have that you have to look at the market. Technicals, a lot of the carry trade was unwound, but if you look at positioning and valuations, there are still risks there. And so some of your more defensive sectors, looking at utilities, looking at healthcare, looking at real estate, staples, telecom, are actually what we have been putting more emphasis on over the near term, looking to now towards, into the elections.